Hello and welcome to BQ Prime. We're at the end of yet another RBI MPC decision. The MPC, as expected, decided to keep the benchmark repo rate and stance unchanged. It also continued to remain hawkish on inflation with its commentary, along with maintaining a close eye on evolving liquidity conditions. To discuss more on today's takeaways from the MPC, we're joined by Tanvi Gupta Jain, UBS India economist, and Dhawal Dalal, CIO-Fixed Income at Edelweiss MF. Thank you so much to both of you for taking time for us today.
Thank you.
So, Dhawal, I'd like to start with you. What were your takeaways from today's policy, especially some of the commentary on liquidity conditions and the benchmark reactions, the knee-jerk reactions we saw on the bond yields?
Yeah, so I think in more sense, the today's policy was pretty much same as what it was previously. The only change which was made was with regards to the RBI's announcement of use of OMO sale to manage liquidity. And I think that was the only additional statement that has set the cat among pigeons in the bond market and which has caused the bond yields to harden. Although I believe that it's a little bit of an overreaction because the RBI has very clearly said that this OMO sale tool is only a liquidity management tool and not an interest rate management tool. So to that extent, we do believe that the negative impact of the price action will subside at some point of time and the market will normalize soon.
And to add to that, I'd also want to ask, what's the liquidity trajectory looking like going forward? After today's commentary, can we expect liquidity to remain tight in the coming months?
So the liquidity, as the RBI governor alluded to, is likely to remain in a partly surplus once the government spending is going to come back into the market. And also from that perspective, between now and the November, we are going to see liquidity a little tighter, maybe plus minus 50,000 crore on average. But the bulk of the move is going to happen November onwards when the large redemptions or the maturity of the government bonds are going to change the liquidity scenario. So at that point of time, we'll have to see how the liquidity situation evolves. But at this point of time, between now and November, we do not expect the liquidity buildup to cause any kind of consternation within the RBI.
Okay, so the OMO operations that the governor alluded to, we would see OMOs happening only post the festive season, like maybe around after Diwali, if at all?
Absolutely. Nothing before that in our view, based on our analysis of the banking system liquidity between now and November.
All right. Tanvi, what were your takeaways on some of the commentary on liquidity as well as inflation in today's speech?
Sure, Pallavi. I think the biggest takeaway was the RBI governors reiterated that our inflation target is 4% and not 2 to 6%. And very clearly, the governor kind of highlighted that the entire idea is to align inflation towards a target on a durable basis and at the same time supporting growth. Because if I look at the policy, I mean, the stance was kept unchanged, the policy rate was kept unchanged. They didn't even tinker the inflation forecast. I mean, here and there, 20 basis point down in the September high on the September quarter, 10 basis point down in the December quarter. But largely, I would say the policy was on expected lines. So yes, one was very clearly RBI is highlighting that 4% is the medium-term target and where they would like inflation to be. In fact, very interestingly, they also released October monetary policy report. And if I look at the trajectory, what they're highlighting, how do they see inflation, say in FY25, the average inflation as per their current forecast, these are staff estimate, not really the MPC forecast. It is still at 4.5%. So definitely inflation is what they are clearly highlighting is going to be within that 4% or around the 4% medium-term target. The second interesting thing, as you guys, just discussed about, is liquidity. Obviously, the market was taken by surprise when the RBI governor signaled that they could consider open market sales to manage liquidity if required. So we are expecting this liquidity tightening operations to sustain. I mean, very clearly, this incremental cash reserve ratio, which is getting discontinued, and there will be some festive season time which is coming in from mid-October to mid-November. and the government spending will also continue. So you are going to see that liquidity conditions remain towards neutral. But I would say if there is a concern that liquidity increase could actually lead to short-term rates closing below the repo rate, I think the liquidity tightening in terms of OMO sales will ensure that at least your overnight call money rate is trading closer to 6.5 to 6.75. I mean, they have been trading at 6.75 or 6.8, but entire idea will be that overnight rates trade slightly higher or closer to the repo rate.
Sure. So, some of the aspects of inflation that you've discussed, did you think it was a little bit contradictory, even going by early forecasts from the RBI for FY25 that you mentioned, for instance, versus fairly hawkish commentary on inflation, along with the governor reaffirming the fact that there are a lot of moving pieces at the moment when it comes to the inflation trajectory? So, overall, what's the picture? Is it a little bit of a mixed, confusing picture that comes across in terms of inflation trajectory?
Sure. So if you look at my inflation forecast at UBS, we are estimating inflation, CPI headline inflation to average 5.6%. So clearly 20 basis points higher than what RBI has been forecasting. Now, if I look at what are the three things I will be watching out in terms of inflation trajectory over the coming months, one, very clearly, I mean, vegetable prices are going to correct. We are already seeing the retail price data for the month of September for tomato especially is down almost 50% month on month. So you will see contraction on a sequential momentum. But I think there are clearly upside risks which are coming. For example, we did see that there were uneven rains. And even though your sowing for summer crop is largely flat year on year, but there is going to be an impact on the crop yields, especially in case of paddy or rice and pulses. And if I look at the actual retail prices, I can already see that there is a sequential increase in price momentum, whether it's rice, pulses, spices. So that is already feeding into my headline CPI inflation. Second is, I mean, oil prices continue to remain high. I mean, monetary policy report of RBI is taking oil at $85 for India. I mean, we have seen that the domestic retail fuel prices in India have been unchanged since May of 2022. I mean, we have not really seen the adverse impact of rise in crude oil prices, even when the number, the Brent was trading above $90 a barrel. Plus, India has been buying oil from Russia at a reasonable discount. But we are already seeing that there is an indirect impact because the input cost pressures faced by the firms, they are seeing that there is some feeding, which we are already seeing. So maybe not direct impact, but there is an indirect impact which is already feeding into the numbers. And third, and I think the most important thing, which we have to understand, that we are ahead of a very tight election calendar. We have 5 states going for elections in November, December. We have parliamentary elections due in April, May of next year. I mean, there will be, or at least we need to be watchful for any risk of populist spending, whether it is pro-rural, pro-social, and that can also lead to much more generalized inflationary pressures. So I think these are the 3 points or the factors which I will be watching out very closely to look at how inflation will actually pan out. But at the current juncture, we are 20 basis points higher than the RBI's forecast of 5.4%.
Got it. Okay, so Dhawal, we saw a fair bit of commentary from the governor today on liquidity management by banks as well. So going forward, do you think short-term rates will see a little bit of a softening now?
Unlikely, given the fact that right now, if you are seeing the 91-day T-bill cutoff, it's coming pretty much close to around 684, 685. We have seen a little bit of hardening on the 364-day T-bill cutoff last auction. From that perspective, I think we do believe that there's a little bit of term premium attached to the overnight rates, which are or closer to the 675 rate and over the 91-day term premium. So I do not expect short-term rates actually to trend lower. In fact, on the other hand, now that the RBI has basically shown their card about using OMO sales to modulate liquidity, my sense is that the supply in the money market will probably increase as some of the borrowers will probably try to preempt the potential hardening of bond money market yields and borrow money ahead of the festival season if required.
Got it. Dhawal, thank you so much for taking time out. This was most insightful.
Thank you very much.
So, Tanvi, coming back